So non-interest-bearing notes receivable. So to continue our discussion with notes receivable, so for non-interest-bearing notes receivable, we define as the notes receivable is considered non-interest-bearing if it does not bear any interest separate from the face amount or unpaid balance of the note. As compared with interest-bearing notes receivable, the only difference of the two on the computation on how do we compute or account for the interest. Both interest-bearing and non-interest-bearing notes are both involve interest, but on how to account and compute for the interest, they differ. Non-interest-bearing notes receivable doesn't necessarily mean it does not have interest. It has interest, but the interest is embedded as part of the face amount or the unpaid balance of that promissory note. So again, don't be confused. Notes receivable that is non-interest bearing to have no interest at all. Again, the interest is already embedded as part of the face amount or the amount appearing on the face of the promissory note. Also, another difference of an interest-bearing note and a non-interest-bearing note is that under the face of the contract or promise to pay for an interest-bearing note, there is a stated interest for that. But on the other hand, non-interest-bearing promissory note doesn't have any stated interest appearing on the face of the promissory note. So we can identify a promissory note if it is interest-bearing or non-interest-bearing, the presence of a stated rate on the face of that promissory note. So for accounting-wise, both involve interest, but interest-bearing promissory note, the computation of the interest is based on a stated rate provided in the promissory note that's being multiplied on the face amount or principal amount of that promissory note. But non-interest bearing doesn't have any interest computed separate from the face amount. Rather, the interest is already embedded as part of that face amount. So if we're going to compute for the maturity value of the non-interest bearing promissory note or notes receivable, the face amount is actually the maturity value. Unlike with the interest bearing, that under interest bearing, the maturity value is computed as the face amount, which is equivalent to the principal amount, plus the total accrued interest. But for non-interest bearing, the face amount is equivalent already to the maturity value. Why? Because the face amount already includes the principal and the interest. So always take note of that, the difference between interest bearing and non-interest bearing. How to compute for the interest? So actually, again, interest for non-interest bearing notes receivable are embedded or part of the face amount appearing on the face or on the contract of promise to pay, which is the promissory note. The interest that we are accounting under interest bearing is treated as accrued interest. In non-interest bearing, we actually refer that interest as unearned interest. In effect, we already received that interest, but as to purpose of earning that interest is referred to first as unearned interest. So how do we compute the unearned interest? It is actually the difference between the face amount of the notes receivable versus the present value of that notes receivable. So present value computation is relevant for this purpose. So the difference of the face amount and present value, that would be the unearned interest. So we can safely say that the present value, in order for us to arrive with unearned interest, the present value of the notes must be less than the face amount of the notes. So how to compute for the present value of the promissory note? It depends on the mode of payment or the settlement of the notes receivable. If the mode of payment is lump sum, when we say lump sum, one-time payment, or in Tagalog, we have it, isang bagsakang pagbabayad. The mode of payment is lump sum or one-time payment. The present value is the face amount times present value factor, which is referred to as the present value of 1. If the mode of payment is installment, you have to look into the type of the installment payment. If there is an advance payment or no advance payment. So present value is the annual installment payments multiplied by the present value factor depending on the mode of payment. If no advance payment, then ordinary annuity or in arrears of 1 will be used. For if there is an advance payment, we're going to use present value of in advance of 1. How to use the present value factors or multipliers? For present value of 1, PV of 1, it is used for lump sum or one-time payment. Example, when the problem provides that at the end of 2, 3, 4, or 5 years, etc. So the problem will state that the settlement of the promissory note is at the end of a specific year or after a specific period, or at the end of 2nd, 3rd, 4th, or 5th year, or paid in lump on a specific year. Those are the clues, examples of the clues that you're going to consider when computing for present value of 1. Also for problems involving computation for present value of 1. For present value of ordinary annuity or in arrears of 1, ordinary annuity or in arrears of 1 are just the same. When we say ordinary annuity or in arrears of 1, it is used for installment payments that require the first payment date at a later date than the transaction date. What does it mean? Example, if the problem provides that the transaction date is on January 1, 2020, but the first payment date of the installment payments is on December 31, 2020. So to consider if it is ordinary annuity or in arrears of 1, there must be a substantial period of time before the first payment. So again, dates are important when computing for present value factors, especially for installment payments. So present value of ordinary annuity or in arrears of 1, it requires the first payment at a date later than the transaction date. How about with annuity due or in advance of 1? Annuity due or in advance of 1, they are just the same. It is used for installment payments that require first payment during the transaction date. Meaning, if the problem provides that the transaction date of January 1, 2020 is the same with the first payment date. So transaction date, January 1, 2020. First payment date, January 1, 2020. There is an advance payment. In contrast with ordinary annuity, that there must be a passage of time, substantial passage of time. So, for example, an annual payment, so from January 1 to December 31, that is ordinary annuity. But the transaction date and first payment date is the same, like January 1, 2020, both transaction and first payment date, then the present value of annuity due or in advance of 1 will be used. How to account for non-interest-bearing notes receivable? So to record the receipt of promissory notes, ayan. Almost the same with what we have with interest-bearing. The only difference is the presence of the unearned interest income account. Then the debit to loss and the credit to gain on sale, if any, it depends on the transaction. If it is a sale on non-cash asset or other transactions other than transactions with customers. So if it is only a mere sale of goods or services, then no gain or loss will be recognized. But an ordinary, okay, ordinary or the usual revenue or income. Record the interest amortization. By the way, non-interest-bearing notes receivable will involve amortization. We're going to have amortization schedules here. The unearned interest will be amortized. So to record for the interest or the amortization, we have to eliminate portion of the unearned interest income and credit it to interest income. Why interest income? Because notes receivable, it is an asset on our part. Any interest is an income on our part. To record the annual collection in case of installment basis, debit cash, credit to notes receivable equivalent to the face amount of the collected value. In case of settlement of notes for lump sum basis, the same journal entry. The only difference is the figure that we're going to post for purposes of journal entries. So the same accounts, debit to cash and notes receivable, only the amounts will differ. So later on, we're going to apply it in problem solving, don't worry. And for the amortization schedule for lump sum basis, we only have 4 columns for that, usually 4 columns. Column for the date, column for interest income, and column for unearned interest income. Then we have the balance or the carrying value of the non-interest-bearing notes receivable. For installment basis, regardless if it is ordinary annuity or in advance of one, amortization schedule, 5 columns, column for the date, then the annual collection. The annual collection will refer to the full installment payments. Then we have column for the interest income based on the unpaid balance. Then principal payments, which is the difference of the annual collection and interest income. Then we have the balance or the carrying value of the non-interest-bearing notes receivable. So let us apply everything else in a problem solving. So on January 1, 2020, Wiz Company received a 3-year promissory note for 500,000 for the machine sold with a book value of 440,000. The note is non-interest bearing. So we have a clue that the note is non-interest bearing. And the implied interest rate applicable for the same note in the market is at 12%. The note matured and paid at the end of 2022. So meaning the sentence or the last sentence provided the note mature and paid at the end of 2022, meaning the promissory note will require lump sum settlement or one-time settlement or one-time payment. The following are the present value factors or multipliers. Present value of 1 for 12% for 3 periods is 0.71. And ordinary annuity of 1 for 12% for 3 periods, we have 2.40. The period will refer to the annual basis. Okay, so the promissory note is good for 3 years, then the present value computation is good for 3 years. So the requirements, the required journal entries for 2020 to 2022. So for lump sum basis, the present value of the notes receivable, we're going to use present value of 1. So the face amount times the present value factor. So 500,000 times 0.71, that would be 355,000. Unearned interest is the difference of the face amount and the present value. So 500,000 minus 355, that would be an unearned interest of 145,000. Loss on sale is computed as the present value of the promissory note minus the book value of the asset sold. So 355 minus 440, that would be an 85,000 loss on sale. So this would be our amortization schedule for lump sum basis. How did we arrive with 355? Again, this is the present value. 145, the unearned interest. How did we arrive with the interest income? Simply multiply the 355 by 12%, we can arrive with 42,600. Then 42,600, deduct it from 145,000, so we will have 102,400. Then 42,600 plus 355,000 will have 397,600. Then do the same thing, 397,600 times 12% will have 47,712. Then from 47,712, deduct it from 102,400 will arrive with 54,688. Then 47,712 plus 397,600 will have 445,312. And in order for us to arrive with the full amount of 500,000, kindly make adjustment for the last amortization. So zero out the unearned interest. In order to zero out the unearned interest, this 54,688, carry it forward here as an interest income. Then zero this out. Then 54,688 plus 445,312, that would equate to a full amount of 500,000. Okay? Because if we're going to compute for the interest income for 2022 on the basis of 445,312 times 0.12 will not equal to 54,688. But because we're going to arrive the full amount of 500,000 at the end of the 2022, what we're going to do is to adjust the last figures. So zero out the unearned interest. So to zero that out, carry forward 54,688 as interest income. So 54,688 versus 54,688, that will be zero for unearned interest. Then 54,688 plus 445,312, that would be a full amount of 500,000. So to record the receipt of the promissory note, debit notes receivable 500,000, debit loss on sale, which is the 85,000 earlier, credit machine for 440,000, and credit unearned interest income of 145,000. Then to record the amortization of 2020 on the basis of the amortization schedule, so unearned interest income, debit, then credit interest income for 42,600. That is based on the amortization schedule for the information in 2020, interest income for 2020. To record the amortization for 2021, the same, based on the amortization schedule, debit unearned interest income, then credit interest income for 47,712. This is the amortization schedule. For 2021, we have 47,712. For 2022, we have 54,688. So our journal entry would be debit unearned interest income and credit interest income for 54,688. Then to record the final settlement of the promissory note, we debit cash and credit notes receivable for the full amount of 500,000. Next, sample problem solving 2. So whilst company received a 5-year promissory note for 500,000 for the machine sold with a book value of 440,000. The note is non-interest bearing and the implied interest rate applicable for the same note in the market is at 12%. The note is payable every year for 100,000, so meaning it is accrued that the promissory note will be paid on an installment basis. The first payment is on December 31, 2020. So meaning we're going to apply the present value of ordinary annuity or in arrears of 1. So the present value factors or multipliers, PV of 1, we have 0.57, and present value of ordinary annuity, we have 3.60. So the requirements, the journal entries from 2020 to 2024. So installment basis, ordinary annuity, face amount, we have the annual collection times the number of periods, 100,000 times 5 years, that would be 500,000. Present value of the notes receivable, that would be the annual payments times the present value factor, 100,000 times 3.60, that would be 360,000. The unearned interest is the difference on the face amount and the present value. That would be 500,000 minus 360,000, that would be 140,000. And for the loss on sale, it is the difference of the present value of the note versus the book value of the asset sold. That would be 360,000 minus 440,000. So equivalent to 80,000. So this will be our amortization schedule. The annual collection is equivalent to the annual installment payments of 100,000. Interest income is on the basis of the unpaid balance. Principal payment is the difference of the annual collection and interest income. So 360,000 times 12%, that would be 43,200. 43,200 minus 100,000, that would be 56,800. 56,800, deduct it from 360,000, that would be 303,200. To signify that the balance of the promissory note is decreasing due to the annual collection. Then do the same thing, 303,200 times 12%, that would be 36,384. Then deduct it from 100,000, we'll have 63,616. Then deduct it from 303,200, that would be 239,584. Then multiply again by 12%, that would be 28,750. 28,750, deduct it from 100,000, we'll have the principal payment of 71,250. So that would be 168,334. So 168,334 multiply again by 12%, that would be 20,200. Consider rounding off of amounts. So 20,200, deduct it from 100,000, we'll have 79,800 principal payment. So that would be 79,800 less from 168,334, that would be 88,534. Then from this one, in order to arrive at the zero balance here, carry forward 88,534 and the last amount for the principal payment to zero this out. Then we already have annual collection here. To arrive at the interest income, compare 100,000 with 88,534. That would be a difference of 11,466 as interest income. So again, the last figures for 2024 will just be unadjusted figures. This balance of 88,534, carry this forward here to zero this out. Then compare 100,000 with 88,534 to arrive at 11,466. So to record the receipt of the promissory note, we debit notes receivable 500,000, debit loss on sale for the loss of 80,000, credit machine for 440,000, and credit unearned interest income for 140,000. Then to record for the annual collection for 2020, debit cash and credit notes receivable for the full amount of 100,000. This annual collection is already referring to principal and interest. So both principal and interest are being collected in this journal entry. Then to record for the amortization for 2020, based on the amortization schedule, debit unearned interest income and credit interest income for 43,200. So yan, the basis of the amortization schedule for 2020. To record the annual collection for 2021, the same, debit to cash and credit to notes receivable for 100,000. Then the amortization for 2021, debit to unearned interest income and credit interest income for 36,384 on the basis of amortization schedule. So the information for 2021. For the annual collection for 2022, we debit again cash and credit notes receivable for 100,000. Then for the amortization, yan, debit unearned interest income 28,750 and credit interest income for 28,750. For 2022, amortization. For 2023, the same journal entry, debit to cash and credit to notes receivable 100,000. And amortization, debit unearned interest income and credit interest income for 20,000 200. So for the information of 2023. And for 2024, our interest income is 11,466. So the annual collection still the same, debit to cash and credit to notes receivable for 100,000. And the amortization, debit and earned interest income and credit interest income for 11,466. Okay, for sample problem solving 3, ayan. The only difference of sample problem solving 3 from problem solving 2 is that on the last sentence, the first payment was made on January 1, 2020, and thereafter every December 31 of each year. Our transaction date is January 1, 2020, and our first payment date is January 1, 2020 also. So therefore, there is an advance payment. Then succeeding collections will be made on December 31 thereafter. So the following present value factors, PV of 1.57 and PV of in advance of 4.04. So the requirements, journal entries from 2020 to 2024. Installment basis, in advance of 1. Face amount, again, the annual collection times number of periods, that would be 100,000 times 5 years, 500,000. Present value of the notes receivable, that would be 100,000 times 4.04, that would be 404,000. And earned interest is the difference of face amount and the present value, that would be 500,000 minus 404,000, that would be 96,000. And for the loss on sale is the difference of the present value of the notes and the book value of the machine. So 404 minus 440,000, that would be a 36,000 loss on sale. So this will be our amortization schedule. So you can see this is a bit different from the amortization schedule that what we have in the ordinary annuity assumption. So as you can see, in sample problem solving 2, our end collection date is on 2024, but here our end collection date is in 2023 because the problem provides that there is a first payment on January 1 and on December 31 thereafter. So first payment, January 1, second payment, December 31 of the same year, then third payment, December 31 of 2021, fourth on the 2022, and fifth on 2023. So we made 2 payments in single year, but the first payment date on the same day of the transaction. So for January 1, 2020 annual collection, since it is an advance payment, there will be no interest income for that purpose because there is no substantial period for interest computation. So zero interest income, so the annual collection of 100,000 will refer only to principal payment. So deduct 100,000 from 404, that will be a 304,000. Then from 304,000 multiplied now with 12%, we'll have 36,480. Then deduct 36,480 from 100,000, that would be 63,520. 63,520, deduct it from 304, that would be 240,480. 240,480 times 12%, that would be 28,858. Minus 8 from 100,000, that would be 71,142. That would be 169,338. 169,338 times 12%, that would be 20,321. Okay? Then deduct it from 100,000, will arrive at 79,679. Then 79,679, deduct it from 169,338, will have amount of 89,659. So adjusted figures only. So to zero this out, carry forward 89,659 here. then compare 100,000 with 89,659. Our interest income for 2023 would be 10,00341. Record the receipt of the note with debit notes receivable 500,000. Then debit loss on sale for 36,000. Credit machine for 440,000 and credit unearned interest income of 96,000. To record the collection for January 1, advance payment, debit to cash and credit to notes receivable 100,000. But we don't have an amortization for January 1, 2020. No journal entry because, again, on January 1, 2020, advance collection, no interest income will be computed. No significant or substantial period for the interest. But for December 31, 2020, we're going to compute now for interest. So we're going to recognize interest income at the end of 2020. So annual collection, December 31, 2020, that will be a debit to cash and credit to notes receivable, 100,000. Then the amortization, unearned interest income debit and interest income credit, 36,480. So on the basis of the amortization schedule. The record annual collection on 2021, debit cash, credit, notes receivable, 100,000. For 2021, amortization, debit unearned interest income, and credit interest income for 28,858. Again, the basis of amortization schedule. For 2022, annual collection, debit to cash and credit to notes receivable, 100,000. And for the amortization, debit unearned interest income and credit interest income for 20,321. Again, on the basis of amortization schedule. And last, for 2023, annual collection is debited to cash and credited to notes receivable, 100,000. And the amortization for the last collection will be unearned interest income debit and credit interest income for 10,341. So, for purposes of interest income, both interest-bearing and non-interest-bearing recognize interest income. But for interest-bearing, it is accrued. But for non-interest-bearing, it is unearned. So how do we differentiate accrued and unearned? For accrued, we have it under interest-bearing. So accrued interest. For unearned, we have it under non-interest-bearing. Okay, so unearned interest. So therefore, we can safely say that there is no unearned interest under interest-bearing and there is no accrued interest under non-interest-bearing. Accrued interest is only under interest-bearing and unearned interest is only under non-interest-bearing. So I guess that's it for our discussion for the notes receivable continuation under non-interest-bearing notes receivable.